Hello, everybody. Thank you for dedicating your afternoons to this final round of the case competition today. We're really glad we can be here, and we're really psyched to see all of you here as well. We are a team from both Duke University and the University of North Carolina. We call ourselves MEMBAs. We're dual degrees getting masters in environmental management and MBAs. We are really excited to be here today to present the Blue Sky Fund, a commingled ESG fund for university endowments. So for the next 15 minutes, what we would like to do is first, I'll go over some fund goals and objectives and briefly touch on our target client base. Then I will hand it over to Eric, who's going to talk about how we are measuring and managing the ESG component of the fund. Then Sydney and Xander will talk about fund structure, risk, and return profile. And then finally, Trip will go over some conclusions and present some next steps. Really broadly, and maybe most importantly, is what is this asset allocation of this fund? We are looking at, again, commingled, very diversified approach to mirror what endowment portfolios allocate their assets by. Really our purpose and our goal is to make sure that funds make sure that endowments can both meet the evolving requirements of student needs as well as maintain long-term purchasing power and risk-adjusted returns. So really our purpose is to provide these endowments with a responsible investing option that retains purchasing power. Our goal is to maintain liquidity and attractive returns with acceptable risk. And we do this by going into 3 fund components. The first is in high-scoring foreign and domestic public equities, measured by ESG momentum strategy, and Eric will talk a little bit about that. Fixed income instruments, Sydney will go a little bit into the environmental and climate bonds and what our strategy is in fixed income investing. And then Xander will go into some really exciting detail about our real asset positions in solar, agriculture, and timber that we're thinking about. So really briefly, our target client base are university endowments of over $50 million these clients have a risk appetite and the purchasing power to start to dig into this new fund. We are requiring a minimum investment of 5% of endowment value based on some research we did that between 1 and 5% of endowments invest in fossil fuels, and this seemed to match, if they wanted to divest that portion or even invest their entire portfolio into this fund, they could do that. The initial fund value, originally we had it a little bit lower, but we've had a bit of an opportunity to look at the market size of common funds client base and really take a look at how attractive our fund could actually be and upped that number a little bit. Expense ratio at 1.2% to reflect the very active management components to our product offering. So Eric is going to talk about the ESG management strategy.
Thanks, Sarah. So Sarah briefly touched on some of these themes, but we really want to talk about a few key things here. First, that we're incorporating the cost of the ESG data, analytics, support, and early reporting from third-party providers into the cost of the fund. We know they do it better. Let's take it, let's build in-house expertise, let's analyze, learn, and grow with that change in data and that quality of data. Investment manager selection, moral alignment. We really want to see that they're walking the talk, that they've got skin in the game and a track record. There's been enough of asset allocation in these sectors to see how managers are performing over time. PRI as well, of course. So now that Common Fund has this solid ESG policy, we really want to take it to the next level and build a framework. So how are we building that framework? How are we building that house? And that's really going to be guided by PRI and then defined by what we see as material key performance indicators that are classified by asset and then by sector. So quick look, our equity strategy is consisting of an ESG momentum strategy based on third-party scores. We're relying on third-party reporting for our equities early on and building that in-house expertise, transitioning over time as that data becomes more and more available. Sydney, in a second, will kind of break down why we chose these assets, and Xander will tell us a little bit more about our alternatives. But I really want to highlight this key notion of material KPIs. This information is available. We can make sense of it. There is enough good information to allow us to make good investment decisions. And as that information is incorporated into market prices, we're going to be able to generate significant returns. One key thing I want to mention on our alternatives is we're focusing on sectors already performing sustainably, SAPs. And what that is, we're relying on sustainability standards in agriculture, timber, to define what sustainability is from a third-party notion, rely on certification where information is publicly available for us to extract, analyze, and make investment decisions. And this is really core to our strategy. And lastly, what are those key metrics? Just 2 examples on the equity side and the alternative side. Again, material KPIs. These are going to lead to long-term performance, and we're relying on them to extract the necessary information we need to make sound investment decisions. So with that being said, I'm going to pass it off to Sydney, who's going to talk a little bit about our target returns and performance.
Thank you, Eric. So we started off this strategy looking at essentially like Common Fund does, looking at sort of a Monte Carlo prediction based on what our returns would be. And we found that it was really difficult with the alternatives specifically, just because we didn't have enough data. And so we decided for a starting point in figuring out sort of where our returns would be to basically look at established indices and then essentially use that as a baseline for our starting returns. And as you can see with so you already saw earlier with the distributions, and we should have put it on this slide. But with our distributions, we have a pretty significant portion in alternatives. And so you'll hear from Xander sort of how we're differentiated with our fund. But here, I'll go through just a quick note of sort of how we thought about these asset classes and where we wanted to focus. So in the first 2, specifically the World ESG and the USA ESG, we felt like on the equity classes, there wasn't a huge amount of manager input that would be substantially increasing our returns here. And so we thought we would start by focusing on the indices and essentially leaving this to MCSI. In the future, we could adjust this if we needed to. If, say, a university wanted to divest from coal or something in those lines, we could also dig further into this asset class. On the fixed income, we specifically looked at mostly bonds here, and so that's why we modeled it across bonds, although there are other different types of fixed income. We specifically didn't look at green bonds on the other side. One thing was a matter of information, so we didn't feel like endowments had enough information about green bonds yet, and they didn't have enough sort of confidence in the returns. And 2, it was just the recent returns didn't look as good in terms of just a quick glance. So then getting into the real estate, and then that was the last major one we had. Again, on the real estate side, we felt like the major area in most of our research showed that the major way that institutions are typically exposed to real estate is through the investment trust. And so we modeled that index based on the investment trust. So the last major thing I want to mention before passing it off to Xander is on our venture capital side. So you'll see we have a pretty significant distribution towards venture capital. We don't intend that on being all double bottom line, but we do intend on having some double bottom line. Ideal in the future, we would like to move closer to our double bottom line there. But again, we just didn't have the amount of, when you move only double bottom line, you reduce the amount of investments you have, and so we wanted to start with more open there. So at the bottom, you can see our baseline returns, and later you'll see sort of with our realistic estimates and how we're treating our managers and how we're looking at our natural resources, how we can actually beat this benchmark.
Thank you, Sydney. So I'm now going to talk definitely about the most unique aspect of our portfolio, the alternative assets. And I want to step out and talk about what my master's project in environmental management is right now. Right now I am interviewing fund managers at the real asset space, more traditional ones like timber, organic agriculture, but then also some more alternative ones in ecosystem service markets like water rights purchases, wetland mitigation banking, and fisheries. And some trends that have come out of asking them what trends they see in their investors and what trends they see in their metrics is essentially that large institutional investors, especially in the traditional spaces of timber and organic agriculture and renewables, are becoming more and more likely to invest. There's an increasing appetite, and especially the larger ones are willing to sacrifice a liquidity premium because they're trying to, post-financial crisis, gain access to these new resources that are very counter-cyclical to the market. And we felt like that integrated really well with our thesis for the Blue Sky Fund, which is to provide stable, attractive, and low-carbon returns. So our baseline value proposition is essentially what everyone and all the teams before us have done, is a baseline scenario of taking historical returns, some from interviews and some from aggregated PE reports, and projecting them out into the future. But I'm also going to talk briefly about an alternative scenario in climate risk. What would we do in that case? But at a baseline, we are providing our investors with a hedge against climate risk, against the carbon embedded in their portfolio. We have a kind of proven track record of investing in timber industries that is going to essentially prove that this is a sustainable investment. And then finally, we have the communication tool. In interviewing these fund managers, a lot of them are generating metrics that are very discrete and can be used as a communication and an engagement tool. Acres under management for timber, pounds of organic agriculture produced for agriculture, and kilowatts of clean energy and carbon avoided for some of the energy sectors. And so these metrics can be used on top of stories like investing in an organic blueberry farm in California, the jobs that it creates, the community impact it has, mitigating food deserts, can be used to excite and engage potential donors, existing donors, students, on top of, and it's not a trade-off because these are historical returns, they're just now adding metrics to some of the positive externalities that these investments already have. And so I want to talk a little bit about a future scenario before I get into these mechanics. The future scenario is we've already had this investment in these real assets, and let's say there is a carbon tax, there are carbon markets, or that there is aggressive subsidies in renewables, or potentially some closing of regulations in ecosystem markets. These positive externalities in, say, agriculture around ecosystems have already generating positive externalities. There is an option value that cannot really be modeled right now in some of the additional water, erosion, sedimentation benefits from the agricultural side. And if it sounds whimsical, the timber industry is actually already doing this in the voluntary carbon market. Some of the funds we're talking to, they've invested in large timber areas, but in places that the timber is high cost, they're putting conservation easements and actually generating carbon credits to sell in the voluntary market. So in a carbon scenario, this would actually generate excess returns with this option value that is very hard to model. And that's the other strategic value proposition that's beyond just this kind of baseline historical returns projecting out into the future. The mechanics are pretty straightforward. We are taking a liquidity hit. It's a 10-year fund. In order to get these annualized returns, we've got to essentially say for 9 years you're with us, tell us if you're out, and we'll give you 1 year, and on the 10th year you can exit, or we'll reinvest into another 10-year fund, and then the fund will continue going forward in the future. And once again, for each one of these sectors, getting an expert and vetting him extensively, and on top, making sure that we are looking at geographic diversity, so you're not investing in the blueberry farm in California, and then all of a sudden there's a huge drought. And making sure we model this with GIS and possibly a small team of interns on top to go with this manager. So with that, I'm going to turn it over to Tripp to close us out.
Thanks, Sander. So Sarah told us about how there's investor appetite for this sort of vehicle, and then Eric walked us through how there's metrics to measure both our long-term risk and to mitigate against that, as well as to make sure we're doing the morally correct thing. And then Sydney walked us through what a 10-year benchmark return might be that would be about 6.2%. And Xander showed us how investing in real assets would help us achieve a 10-year return of 8.8%. So we're providing fiduciary responsibility to our clients, and we're also working to help the universities engage more with their student body and their alumni. As folks have mentioned, this is not the most liquid fund, but as there's a new shift in investment focus towards long-term vehicles, we think we're positioning ourselves well for the future market there. And so however the political climate evolves, whether carbon is taxed, whether it's not, whether ecosystem service markets pick up, whether they don't, we're well positioned for all of those potential scenarios based on our real asset investment strategy. And so with that, I'd like to thank you all very much for your time, and this has been a wonderful learning opportunity for us.
Speechless.
So you've done a lot of work here on expected returns. Would you ever consider comparing them to an agnostic index? You know, ESG agnostic.
Yeah, sure. So,
Are you gaining or losing return with your approach?
sure. Is that slide hidden?
No, it's still there.
Maybe we.
It's the old.
Must have switched over. So we did look at this a little bit. If you can see here, so we basically looked to say basically essentially looking at sort of the typical MSCI USA. I'm sorry, MSCI USA index. And we did that across the public equities. And so that's essentially where we stopped in looking at that. On the alternative assets, it was a little more difficult because all we had was sort of the index, which quite frankly doesn't really tell the whole story, since you invest venture in different times, and your returns are not as predictable like a public equity would be. So that's why we stopped at sort of the marketable securities analysis, and then we sort of started here. But we also can't appreciate the fact that it's only 5 years. We did 5 years as opposed to a longer time horizon, because many of these indices haven't been around that long. So if you look at the MSCI index, they actually didn't have the 10-year projections yet, and so we stopped at the 5-year here, but it doesn't tell the whole story, and so we appreciated that, but we thought it told enough of the story so that we could sort of start there and then adjust as we went along.
Did you ever look backward?
So we did look backwards a little bit, but I think for our major way we were looking, since most of the ESG, like I said, indices were pretty new, we didn't really trust sort of what they were saying on the backward side. So you're correct, we could have looked backward on the standard ones and the non-ESG, but we didn't really think that would be a fair comparison to what was going on in the future. So.
I have a question. So you've done a multi-asset class portfolio, but it seems like the drivers of the impact and the return are the alt assets. So why not do 100% alt assets fund rather than a multi-class fund?
I think that might be mine too. So essentially, it was a diversification of risk. So we thought about an alt asset side, and so I will tell you, Xander would have loved that. So
That's why I passed the mic off.
so that was Xander's preference, but. Yeah, correct. But I think in terms of looking at in terms of both the risk and the liquidity, we really wanted to make sure that we were more balanced, and we had a solution that was applicable to not a small subset, but a larger subset of common funds clients.
Okay, so where's the Sharpe ratio analysis?
So we actually didn't do the Sharpe ratio on the actual slides. We looked at it. We didn't bring those numbers just because we didn't know how deep in the weeds we wanted to go. But in terms of the Sharpe ratio, that would have been our next step, to basically present that information and say, here are the specifics on the Sharpe ratio. And I think that's something we could have included, and we just decided not to include that in the specific details of the slides.
What's the answer?
I think we struggled too on the data side. It was really hard to find data that we felt comfortable using to come up with that kind of information.
Correct. And the other thing, in regards to the Sharpe ratio, the reason we decided on sort of looking Monte Carlo versus Sharpe, we know Common Funds prefers to look more in the future, and so we didn't look so much at the Sharpe because we knew Common Fund was our client, and so they weren't as sort of high on the Sharpe ratio. And so, to be quite honest, that's why we didn't include it in the slide, mostly because we don't want them to say, oh, well, we don't look at the Sharpe ratio specifically as our major indicator.
A quick question on the value in the real assets slide.
Yes.
So you have these aggregate beta scores, and then later in the next, in the mechanics, you have the beta average, whatever. This is really just a clarifying question. This beta is, what does this represent? So in my mind, beta is the market. So for agriculture, you have 0.85 average beta of your exposure. What is the market that you're referring to? Is it the cap?
It is historical. It is historical returns, and there's some fund,
relative to what?
relative to S&P 500.
Okay, so it is, you're getting your beta from agriculture, but you're comparing it to public equities?
Yes.
Okay, that's what I want to know. Because
Certainly.
I was curious, like, what
Certainly.
is ag beta?
Certainly, and there's some good reports that kind of come out because both industries do say we're a strong market hedge, even in private equity, to public equity exposure. And then one other thing is, I didn't mention there was the ability to pivot. That's our initial weights, but if I go back a slide, depending upon the investable opportunities, there can be kind of some shifting weights that these fund managers can employ.
You are aware that there is a fund called Blue Sky Fund, just for trademark purposes.
We were not.
They trade water in Australia.
We're not.
When we come, we'll take them
It
over.
will, yeah. M&A opportunity.
There's also a fund that trades weather futures, and I saw ecosystem services as a category. So what could fit in that when it becomes more stable? What are you thinking?
So the one that has already had some deals, not a lot of institutional investors because the risk is incredibly unstable, is wetland mitigation banks. We counted ecosystem services as carbon markets, carbon trading markets, and in looking at looking at kind of some of these voluntary markets, the voluntary markets actually are pretty positive for the people that do invest in them, but once again with very high risk. And once again, it's just to highlight that these ecosystem markets would have an option value in the future.
Question about
Yes, sir.
metrics. Is the idea here that common fund would develop these metrics, which are really, or do you leave it to the manager?
Certainly. So the managers would kind of invest in, for instance, a TIMO, and a lot of the funds that we are already talking to, they collect these metrics to share with sometimes their institutional investors, their high net worth individuals, partly as engagement because they are investing sometimes for impact, regardless of the returns, just making sure that all the managers would be able to roll that data up into a single report, I think would provide a very compelling diversification of acres of timber, pounds of organic agriculture, and once again, kilowatts produced at the expense of not emitting carbon.
Our framework and selection and trend towards material KPIs, we've chosen those because those are definable. We know where we can find that data, and we know what it's going to tell us.
It's not dependent on the manager.
Yeah. It's a two-way street, right?
Certifications.
Yeah. So, that's okay.
Sorry.
Yeah.
Side point. Side point.
Any other quick questions? Otherwise, I think we're.
Thank you very much.